While tariffs don't cause inflation, they distort markets. They change relative prices. They push resources away from where markets would naturally allocate them and toward politically favored sectors. That means higher input costs for manufacturers, higher prices for consumers, and fewer opportunities for exporters, all within a fixed economic pie. Hello, welcome again to another episode in this week's economy. Thank you for joining me again today. It's always a pleasure to have you here. Be sure to hit the subscribe button, like it, follow me wherever you can, and be sure to share it with your friends and family. Hopefully they too need to understand how we can let people prosper and have more, interesting discussions about pros and cons of different things. That's what I hope I'm providing for you as we're learning about all this together as we go. So look, we're entering the final days of the first year of Trump's second term, and the economic picture looks very different from his first. Last time, America saw strong growth driven by pro-market reforms like tax cuts, regulatory reductions, and a broader effort to unleash productivity. This time, the administration led with the opposite approach, sweeping tariffs and industrial policy first, and only later moved to tax cuts and deregulation. That reversal in priorities has stalled, not strengthened the economy. Now those tariffs are at a defining moment before the U.S. Supreme Court, where the justices are weighing whether any president can unilaterally impose, quote-unquote, emergency taxes on Americans. Yet even as SCOTUS debates the limits of executive power, the administration is doubling down with tariffs, rebate checks, instead of simply lowering the taxes themselves or, in fact, eliminating them. But there is good news. Amid the chaos, health policy is finally front and center. That opens the door for meaningful reforms that put patients, not bureaucracies, not insurers, or not federal mandates at the center of care. So in this week's economy, I'm going to break down the challenges and the real opportunities ahead for economic growth and the issues that let people prosper. That's what I'm all about, right? Number one, SCOTUS reviews Trump's tariffs. In the news, earlier this month, Supreme Court held oral arguments in Trump versus VOS selections, a case that will determine whether presidents can continue unilaterally taxing Americans through emergency tariffs. President Trump has also floated the idea of sending Americans $2,000 rebate checks using tariff revenues. But Treasury Secretary Scott Bessent noted that such a rebate would require congressional approval. So there's a lot of different things that are being discussed here, especially if SCOTUS finds that these are unconstitutional. So let's clarify first what taxes are, like I have many times, but let's do it again. Tariffs are taxes. Say it with me. Plain and simple, tariffs are taxes. And under the Constitution, the power to tax belongs to Congress, not the president. Offering rebates or bailouts to industries harmed by tariffs, like farming, is just Washington trying to patch a hole it punched in the economy. Americans don't need rebate gimmicks. They need lower taxes, less inflation, and stronger economic growth to really help with the affordability crisis. What the court must decide then is that the court's key decision is, did President Trump exceed his authority under the International Emergency Economic Powers Act, IEPA, when he imposed sweeping tariffs on U.S. trading partners? The administration argues the tariffs are necessary for economic security, but in recent National Taxpayer Union's coalition letter, 463 economists, including myself, made the opposite case to the court. Emergency powers were never meant to authorize long-term unilateral tax hikes. In fact, they were supposed to be reducing trade barriers. While tariffs don't cause inflation, they distort markets. They change relative prices. They push resources away from where markets would naturally allocate them and toward politically favored sectors. That means higher input costs for manufacturers, higher prices for consumers, and fewer opportunities for exporters, all within a fixed economic pie. The result is misallocation, less productivity, slower growth, and a poorer society overall. You can find more information about this where I detailed the case of the Supreme Court, the NTU Coalition, and the best pro-growth solutions in my Substack newsletter, SCOTUS Hearing Today. The real trade threat is keeping Trump's tariffs. Don't miss that. Number two, Texas Governor Greg Abbott's property tax plan. In the news, Texas Governor Greg Abbott released his 6-step overhaul, the property tax system. It's also noted as a 5-step plan that he's posted elsewhere, promising relief for soaring appraisals and runaway local tax hikes. My take is that this is a step in the right direction, but not the finish line. Governor Abbott's plan is a welcome step in the right direction and an explicit acknowledgement that Texans are tired of renting their own property from the government. It's ridiculous, guys. Come on. His reforms reflect what fiscal conservatives have long said, including me. Property taxes are high because what? Government spends too much. But let's be clear. While the plan is progressing, it's not the destination. Texans deserve full ownership, not another round of temporary relief. Full property ownership is got to be the goal. Property taxes are fundamentally unjust. They punish investment, discourage homeownership, and treat property as something you lease from the state instead of something you truly own. The real solution is straightforward, though not politically easy. Spend less, tax less, and let Texans finally prosper by owning their home. Texans don't need another patch. It requires a roadmap for elimination. The 3-step plan that I think would work best is a true path, really, to property ownership, requiring a simple structural plan. Step 1, strengthen the constitutional spending limit to include state and local government spending at no more than population growth plus inflation. Use budget surpluses where revenue grow more than that to buy down property taxes every year, by the state doing that for school property taxes until they're eliminated, and local governments doing that to their own property taxes until eliminated. You replace all this with a budget-neutral, broad-based sales tax along with spending restraint to lower the overall tax burden. We can't just be swapping out burdens. We've got to lower the burden, and that comes by spending less. So when you look at all this, what we really need is a shorter plan that could get us to where we really need to be, which is eliminating property taxes. And they could do it now. He could call a special session, as State Representative Brian Harrison has acknowledged. 3, shutdowns end, but it puts more healthcare policy in the spotlight. This was the longest federal government shutdown, has finally ended after 43 days, but it left healthcare front and center. President Trump says he's in talks with Democrats about a direct healthcare payment plan as part of broader negotiations to address soaring insurance premiums and other healthcare costs. At the same time, the Wall Street Journal released a devastating investigation into Medicaid's provider networks, exposing exactly the kind of systematic failure you get when Washington tries to centrally manage a $900 billion program through giant insurers who get paid whether or not patients receive care. The incentives are all screwed up, guys. My take, it's time to fix our healthcare system. President Trump is saying what millions of Americans already know. Healthcare costs too much, and the system is tilted against the very people it's supposed to help. But the new quote-unquote solutions coming out of Washington, which includes Trump's deal with Pfizer under the Trump RX, or his idea of the most favored nation drug pricing, those don't cure the disease. They are the same government-driven model that created the crisis and the problem. It will make things worse. Medicaid enrollment has surged over the past decade. Costs have skyrocketed. Insurers' revenues have climbed to the tens of billions of dollars, but none of that magically increases the number of specialists, shortens wait lists, or solves the workforce shortages created by regulations, licensing barriers, scope of practice limits, and certificate of need laws and reimbursement so low that many clinics simply can't survive. A system built on faulty provider networks, bureaucratic contracting, and centrally dictated prices cannot deliver timely, high-quality care, no matter how much money Washington pours into it out of our pockets, right? So how do we cure this sick system? Real reform requires structural change. End the employer-based tax credit distortion, and give workers direct ownership of their healthcare dollars. Expand competition through no-limit health savings accounts and voluntary direct care models. Block grant Medicaid to the states so they can innovate, restore flexibility, and enforce real accountability. Related to this, check out my new co-authored book, as I mentioned before, with Dr. Dean Waldman. It's called Empower Patients, A Cure for America's Healthcare System, which is really a two doctors cure for this, and the deeper dive research behind ATR's Empower Patients initiative that you also don't want to miss. Also, you can read my recent piece on Medicaid ghost networks that's over at Substack. Number 4, credit card fee changes. In the news, after nearly 2 decades of antitrust litigation, Visa and MasterCard have reached a settlement with U.S. merchants that could lead to tiered pricing at the register. Retailers would gain more flexibility to charge different fees depending on the credit card a customer uses. But the agreement still needs court approval and is expected to face pushbacks, especially from some merchant groups. My take on this is that we need more competition. Nothing is free. It's easy to criticize banks and credit card companies for charging fees, but the reality is simple. Like I said, nothing is free. Interchange fees are what make the modern credit ecosystem work. On a typical $100 purchase, about $2 flows from the merchant to the banks and networks that handle fraud protection, secure payments, and credit card reward programs. In exchange, customers get safer transactions, access to credits, and those rewards, while merchants gain more sales and fewer bounced checks, if anybody's using checks anymore. I know I don't. What the settlement means? Well, the silver lining is that a negotiated settlement is far better than any federal mandate that's been discussed in recent years. Congress in several states have been pushing price controls on interchange fees that could have gutted rewards programs and increased costs overnight. This agreement avoids that shock, at least for now. The answer then is that the real problem isn't the cards, it's government regulations that distort incentives and threaten the credit system's stability. Price controls sound good in a talking point about lowering swipe fees, but the trade-offs are harsh. Fewer rewards, higher annual fees, and reduced access to credit, especially for low-income families. That's not consumer protection, guys. It's economic self-sabotage. Related to this, I break down the federal and state proposals on credit card interchange fees here in my recent piece, and as over at Substack that you don't want to miss. I've got some good insights in there as well. Number 5, in the CFPB's funding. In the news, the Trump administration's most direct move yet to dismantle the Consumer Financial Protection Bureau, the White House has formally determined the CFPB's current funding mechanism that comes from the Federal Reserve is unlawful and has barred the agency from requesting additional money from the Fed. With no new funding allowed, the CFPB is on track to shut down once its existing cash runs out, which could be early next year. My take on this is that this is a welcome move. It's something I've been calling on for a long time, and this is a welcome step from acting CFPB Director Russ Vought, my former boss, who knows better than probably anyone that agencies like the CFPB aren't built to improve markets, but to control them. The CFPB operates in the shadows, funded through the public-private Federal Reserve to the tune of $600 million a year, even as the Fed is running operating losses because they didn't do a good job with their interest rate spreads. This setup bypasses Congress's constitutional power of the purse and leaves Americans paying the price for unaccountable regulations. The agency, the CFPB, has pushed a series of harmful rules that have made the life harder for American families. From Section 1033's open banking rules, and it has intrusive data sharing mandates, to banning medical debt from credit soaring. The CFPB repeatedly undermines consumer choice, restricts access to credit, and disrupts markets, all while advancing ideological priorities that have nothing to do with protecting consumers. So what should we do? We need to abolish the CFPB. The CFPB has been a detriment to consumers and the economy. The best safeguard for Americans is not an accountable bureaucracy, but a competitive marketplace grounded in voluntary exchange, private contracts, and open innovation. Consumers thrive when government gets out of the way, not when regulators decide which financial products or services are acceptable. It's just messed up, guys. It's ridiculous. Related to this, watch my clip explaining how the CFPB hurts consumers that you could find the show notes page as well. Number 6, moving up, AI task force and data centers. Well, in the news, the attorneys general of North Carolina and Utah are partnering with OpenAI and Microsoft to launch a new AI task force with more states and companies expected to join. The group aims to establish basic safeguards to prevent harm and identify emerging risk as AI evolves. Earlier this year, these same AGs pushed to remove an AI moratorium from the One Big Beautiful Bill. Meanwhile, the rapid rise of AI has fueled a national-level push for more data centers, which the federal government has now deemed a critical priority. And they are. All right. There's a lot of good resources for that. My take is that AI promises benefits. Artificial intelligence is helping millions of Americans every day, including me, including probably you. These tools have made life more productive, efficient, and accessible for decades. It's really just advanced computing. Now that AI is finally affordable and widely available, policymakers are treating it like a threat. New state regulations don't just target quote-unquote big tech. They sweep in small business owners, developers, teachers, and families who rely on AI to improve their work and daily lives. It also looks at the precautionary principle. We must ensure task forces like this aren't fueled by fear. When fear drives policy, freedom and liberty gets crushed. The precautionary principle is a popular but deeply flawed idea by government that we must regulate that which we don't fully understand. Just in case, all right? That mindset has already stalled innovations like flying cars, advanced nuclear energy, and faster medical breakthroughs. It doesn't make us safer. It slows progress before it begins, especially for those without lobbyists or legal teams to navigate the costly maze. The cost of that lost opportunity isn't just theoretical. It's jobs, productivity, and personal empowerment. So what does a principled pro-growth AI strategy look like? Double down on the deregulatory backbone of recent AI executive orders and speed up permits for all data centers and semiconductor fabs, not just the politically connected ones. Compete with the EU not by out-regulating or out-subsidizing like they're trying to do, but by out-freedoming. Keep rules light, courts predictable, and capital deep. This can also replace corporate-specific deals with broad-based tax policy that lowers marginal rates hopefully to a flat rate and removes distortions. And on semiconductors, focus government on lowering costs and eliminating trade barriers rather than picking winners and losers. You can relate to this. You can listen to my recent conversation on AI with Kevin Frazier, which was a great conversation that you don't want to miss. So with all that, thank you for joining me in this episode of This Week's Economy. For more insights, visit vanceginn.com and get even greater value with a paid subscription or a complimentary subscription to my Substack newsletter at vanceginn.substack.com. Paid subscription would help me out tremendously, though. So until next time, God bless you and let people prosper.